Hey guys, super happy to be here once again. And today we have McIntosh. It's a pleasure to have you here. So before we're going to be starting the conversation, I will say a few things about you. You were managing a lot of money, chief investment officer for so many years. And I think the conversation itself will be fruitful and delightful for you to derive notes. So without further ado, Roger, pleasure to have you here. It's
Thanks,
a
Afik. Great to be here, mate.
complete. Thank you, thank you. So yeah, thank you for coming. Now, before we get to work and dive into the conversation, please tell me more about yourself, me and
So,
the people who will be listening to that recording session.
sure. So, I really find your podcast fascinating, and half the reason I found out. So, it's interesting. I'm chief investment officer for a regional, dare I say, with the Australian words coming out, it's a superannuation fund, pension fund. And but my background's actuarial quantitative originally, and I originally pursued an actuarial career, and as I always say, I was a data scientist long before it was sexy to be a data scientist, and helped set up Vanguard's investment team in Australia. And so I joined Vanguard about a year after they started managing money in Australia, and set up quite a few of the index funds that they now. It's astonishing just the size, and would love to discuss with you. I think that's fascinating to see the challenges and how the markets evolve with the amount of money that's in index funds these days. But I ran the equity team at Vanguard, built quite a few of the funds. I built the multi-asset class portfolios for the Australian client base, and then ran the bond team as well. So I think there's very few people in this world that can honestly say they've run equities and bonds, and using very quantitative techniques. And we'll come to this again as well, because I always remark that anyone who says it's easy to run an index fund is lying. It's actually
Yeah, well,
it's a very
I can
difficult
guess
thing.
that he's lying. Look,
Yeah.
I have my first question. Let's dive from there.
Yes.
Uh, I
Go for it.
as you said, I have never heard about someone who were specialized in both equities and bonds and managing them
And end
both.
up
And I
running
would
my own
like
quant investment strategy subsequent to
eh,
leaving Vanguard. And
and using quantitative methods and quantitative
yep,
methodologies in order to manage it properly. So obviously, we all know the efficient market hypothesis, and I think that
agreed,
everything grew from that point, where the
agreed.
hypothesis says that those two asset classes are completely converse to each other. And I would like to ask you directly, how do you think that's supposed to be proposing a quantitative approachment to equities and both to bonds, and how you were managing them both? Because
Sure.
you think
You, you do
most
use
of them.
different techniques, particularly more for bond portfolios. I used to wind up quite a few equity colleagues that were both sort of saying that, a good bond portfolio manager makes a good equity portfolio manager, but not necessarily the other way around. And if only because I think even particularly whether it's running I've got colleagues who run very quantitative bond portfolios, but even in the index context, um, it, you sort of think about it's not, and it's just astonishing the size and the scale of the index funds now. They coin the technique full replication, which you can do with everything from the S&P 500 through to the Australian domestic indexes here. Um, so you can, in effect, replicate the index rules. You can't do that with bonds simply because there's just so many of them. You can't actually own them all. And so you end up building quite quantitative techniques to what we coin, you're trying to optimize the replication process. So the simplest way to describe it is, rather than trying to replicate it by owning a proportion of every bond that's issued that's in the index, you try and construct the process with quantitative processes to say, right, I've got to replicate the factors of the index. And and it's in one sense slightly easier to do with bonds and equities, you could do the same thing with equities. My first intro to running quant strategies, I helped set up Vanguard's local fund that follows the MSCI Global Small Cap Index. And, I shouldn't say only, that fund was seeded with $100 million Aussie to track a 4,500 stock index. And guess what? You can't own all of them. You
Really?
have to use
Uh,
quantitative. You have to use quantitative tech. It's just simple as you can't spread the money out that far. And so that's the fascinating thing around how you evolve the quantitative techniques that you use to be able to construct the portfolios to pick up
so
the
how
kind of quant
how
factors. So,
you're
and I mean, I beg your pardon, mate, you go.
how so let me ask you, how do you actually vote those quantitative methods? Now obviously you had
Sure.
100 million dollars, Aussie dollars,
Yes.
obviously, and you
Correct.
knitted and you had an origin to spread them across 40 45 4,500 different equities.
100
So
equities. Yep.
my question is, how do you know originally
Sure.
how to spread the money across
Yes.
all of them? How do you know
So,
how to create positions,
so
um,
sure. So
and
what you're
picking the
trying to do,
stocks?
sure, mate, because in it's sort of a bit easier to explain in the context of equities, but it then extends out into bonds because what we kind of look at, and you're probably familiar with you've seen enough of this concept, especially comes out of the academic literature, the whole nature of you can describe the returns from instruments more broadly, not just equities or bonds, by factors and everything from, right, does the stock belong? Is it a US stock? Is it a tech stock? Is it an utility stock? So an industry or a country is a factor. And then you start looking at more quantitative factors around, the very traditional ones, value factors. What's the price earnings ratio? What's the dividend yield? And my quant process looks at about 15 different factors. And so when you're using a more quantitative approach, and it's interesting because in the context of running an index fund where you're trying to what they call um, optimization approach, you're trying to replicate, right, the portfolio's got to have the same price earnings ratio as the benchmark. It's got to have the same proportion of US IT stocks. You've got to have Apple, Microsoft, Nvidia in roughly the same proportion to start off with. And I'll come to that in a moment around how I think that's changing things. So you recognize that if you get that component correct, you don't have to own every security in the index to be able to replicate the returns of the index. That's the important difference. And people often confuse that. You think, I've got to own absolutely everything in exactly the same weights. No. And there's quantitative techniques you use to measure this. The term's called active risk. How different is the portfolio to the index? And then it goes one step further in the bond context where you replicate, because it's the universe of instruments that you've got to um, optimize from and run the processes on is so much broader. And in the context of bonds, you're not just looking at you're looking at different quantitative factors alongside, country and industry. What's the duration of the portfolio compared to the index? What's the duration within particular countries? What's the convexity of it? All these other more quantitative fixed income factors alongside sort of ones that you could explain to people as well. I hope that makes sense.
Mhm. Yeah, well, it makes total sense, and I would like to extend that direction a little bit more. You were mentioning that you had 15 quantitative factors. Now, obviously, multiple factors
Correct.
could lead a tremendous confusion in the process, or will be a total process that eventually
Yes.
helps you digest data in a very healthy manner. Now,
Correct.
obviously, it depends on what data you're actually digesting or
Agreed.
ingesting inside of the funnel. And my question is, okay, you have 15 different factors. How do you know what factors to use, and how do you utilize the factors that you're actively
Yes.
using? Now, before I will let you to address the call, quantitative factors is a thing, and Financial factors is another thing. Now,
Sure.
most of the people does regression, and after they
Yes.
do regression, they
I know.
insert the results insert the results onto a covariance matrix
Various
into a
matrix.
covariance matrix to understand exactly precisely what are the factors that impact the asset.
Yes.
Quantitative factors are completely different. This is 180 degrees the
Agreed.
opposite, and we're supposed to understand the distinction between two kinds of the factors. And from you, Roger, I would like to understand the type of the usage of the quantitative factors on
Sure.
top of financial factors.
Indeed, because you're absolutely right. Is I having built smart beta portfolios at Vanguard, you know, mindful of too much lingo, but it's it's quite common where you see like a very common smart beta fund is a value fund or a momentum fund or a quality fund. So we kind of categorize the factors broadly into the quantitative factors into those groups. And um, I use them in a way slightly different to exactly the sort of what you described was, I reckon, the more traditional way that you try and sort of regress the returns against the factors to try and say, right, how do you do it? And it's been an ongoing process. And apologies for the cricket analogy for those, but I kind of always remark that um, so it's the multi-factor models I've found are the ones that work the most. I always remark that you're looking for the factor all-rounders, not the specialist batters or bowlers, because you've seen with value factors, particularly in the United States, if you had a value fund, how much you've underperformed, and it's a separate discussion around what's been driving. Um, Particularly what's just been going on with the IT stocks and whether or not you can define that it's just a particular factor thing or capital flow going into index funds. There's so many different things, but in the context of how I use them, I do broadly categorize, but I take my own views on definitions within those broad groups between quality, momentum factors, value factors. And it was actually through some good academic colleagues. There's a professional body I'm involved with here, the Q Group, and we always got academics. It was basically about bringing academics and practitioners together. And it's a Butte paper, an academic who was up at Australian National University, a guy by the name of Stephen Satchell. It was a paper that he presented back in my Vanguard days around this whole concept of factor ranking. And it's my process evolved out of that. So it basically works around which, and I've seen it hands-on. I've managed global equity portfolios. I've managed regional specialist Asian small cap portfolios. And I'm sure you would agree that the factors that drive Nvidia, Apple, and Microsoft are totally different to the factors that drive the returns for regional Asian small cap names. And but there are sort of some common elements. Doesn't matter what sort of business you're running. I always remark I've seen in quant forums, colleagues get overly complicated with the way they try and describe their quant model, and it's I've found the gist of Stephen's paper. I'll share it with which was basically looking at factor ranking. The gist of it is that how much more information do you get out of your process by saying, Nvidia's price earnings ratios, it's only back to 50 times now, and AMD's 35 times. Um, is there how much information is there in looking at the two numbers versus right, Nvidia's got a higher price earnings ratio than AMD. And so
Mhm.
it's utilizing that information in a more broader context. And I've got different definitions for the different factors. And it's been an interesting challenge around how do you decide to weight the different factors within this process. And um, it's an interesting one. I've found you think about the intrinsic nature. What's a value factor? What's a momentum factor? They're intrinsic. You're using the stock price for the exact opposite reasons. A value
Mhm.
stock's got, whereas a momentum stock is typically, the gist of it is how MSCI or FTSE define it as, the stock that's performed well over the last 12 months is more likely than not to perform well over the next 12 months. So whereas quality factors don't use share price at all, most typically, because it's typically balance sheet structure. It's revenue growth and earnings volatility and those sorts of things, which aren't related to the price at all. And I kind of almost remarked that quality tends to be the middle child that sort of, there's this constant tug of war between value factors and momentum factors going on in the market. So how I define the process, and I've started using some more machine learning algorithms to try and figure out what's a sensible way to allocate to the factors. But I've used reasonably stable models around factor allocation. So it's a multi-factor sort of approach, and you utilize a combination of macroeconomic elements and acknowledging that, you know, um, value factors aren't as relevant for IT stocks as they are for stocks in other markets, and so weighted accordingly. I hope that makes sense.
Mhm.
And it's a
Yeah,
really interesting challenge. Yeah,
yeah, obviously that makes total sense, and it is a significant challenge. And I think that the importance of understanding how to weight those factors is, I would not say the most, but one of the most important aspects to look at, because
yes,
you really want to know what factor caused the most variance or the most of
agreed.
the impact over a particular asset, or most importantly, over a particular position that you're actively
Yes,
trading.
yes, yes.
And let me ask you this: when our capital is already deployed and you after execution, how do you manage looking at the factors in terms of understanding its return,
Yes,
its potential return, if your thesis had been broken, if your thesis had been restored
good
perfectly?
point, mate.
How do you know how to analyze this, and how do you know
Yes,
precisely how to assign value to the factors that
yes.
are actively contributing, you know,
It's a
the
really
majority of the explanation that you're actively looking for?
it's a great question, Afik, because it really comes down to I'd be interested in you and your colleagues' thoughts around. Um, you can absolutely, back test something as much as you like. I kind of coined the process more. You've got to I have a process of ongoing ex post testing. Right. I've used this group of factors in this process. How did it go? And you then have to, I sort of do testing on that basis to say, well, given the info, and this is the other really interesting challenge is the data that you use to be able to construct it. I've got my own process, Python code, and the database and my data feed from um, Refinitiv, and I quite intentionally make sure it utilizes the data that it was captured at that point in time, because typically what can happen with a lot of the data sources that you use is if you kind of sort of go, okay, well, go and tell me what the analyst's information was from back at the start of the month. And with some of them, they may actually sort of say, oh, actually, some of that information by the time you get to it has been updated. So it's not exactly the data that you would have had at that point in time to check whether or not the information that it was providing was useful or not. And so it's interesting to see how you can do these sorts of things, and then you have to test it still. It's like, right, I always wind up my both of my children who have absolutely no interest in quantitative mathematics at all. One's a journalist and one's into film studies. The share market, as far as the quant's concerned, is a glamorized fashion contest. Everybody gets a score out of 100. How I can define out of 100 can be different to you. That's okay. That's what makes the market go around. But then you've got to test that process on an ongoing basis. I update my factor model once a week. And again, it's an interesting one. I kind of always cheekily remarked there's a sensible holding period between the day trader and Warren Buffett's favorite holding period. And
Mhm.
remember, Warren's favorite holding period is forever.
Mhm.
And
Look,
it's a,
first of
yeah,
all, I would have to say a few things about the holding and about
yes,
about the holding period. Basically.
yes,
So hold itself, it's a decision that
agreed. You're right.
the investment committee or the investment officer is supposed to be receiving. Now, based on the holding period, which is something that it's completely controversial. I
Agreed.
think that
Agreed.
in very short term, especially market microstructure, there is no logic at all. The market is not driven by logic.
No,
It's driven by institutions with larger funds,
absolutely.
with by market makers that aims to provide liquidity, aims to make money. People makes no sense out of the market based on a previous events, or they constitute positions. Now, my question to you is, how do you know when you like the entire picture of factors or the entire thesis have been broken? Because if you are unable to detect it before the market will
Yes,
commit a change, that might be a hell of a struggle by the end of the day to approximate or to assign value to what causes the
agreed.
change. And you that point you're unable to measure risk properly because the market have already
Yes,
made its mind, and you
changes.
are driven by the market, and you are
Yes,
unable to detect the actual regime. I would not say regime, but I would like to say the change in the data sets and the
absolutely, mate.
change
It so
in,
boils down to
in the
change in
variance.
those things. Yes,
Great. And how do you how do you think about that process entirely, or as a pipeline
sure.
to know? How do you know, or how do you used to be managing your risk properly?
Again, a great question because it's changed and evolved over time. I've been running my quant process for, it's a bit scary, over, it's coming up to 11 years now. And in that time, my global equity portfolio has outperformed MSCI World by around 3% per annum for the last 10 years. And where it comes down to is what I've found in the testing process and then this ongoing X testing process. And there's some different academics and market practitioners who've described this as well. You genuinely see what I coin alpha decay. And so, right, my process comes up with an alpha signal, and it is literally everyone gets a score out of 100. And then, as I kind of remark, if my factor quant processors figured it out, that some other much smarter ones than mine have figured it out as well. And what you genuinely see is this decay in the signal. And so this ranking process, and I've gone through and done quite extensive testing on this, has seen that at a certain point, and then there's an interesting answer to the question around like I said, I literally look at a percentile ranking. Once the stock gets below a certain percentile ranking, to my mind, that's the point that I don't want to hold the position anymore. And you still got a strong discipline process around it. And um, it's interesting because this is where having a multi-factor approach makes a lot of sense, because your typical momentum signal can absolutely flap around quite a fair bit based on sentiment. And so how do you combine those is the interesting challenge. But what I've genuinely found is there's decay in the signal. And so once it gets below a certain threshold, I'll sell the position and I'll pick up another one. And it
So,
yeah,
sir, I
it's
have a question.
go
I
for it.
have a question. How do you know how to set up the thresholds?
Dare I say that's the ex post testing coming through. I try and sort of look at, right, if I sold the position, what did the stock do subsequent versus, but and the other thing, I don't tend to look at individual stocks. So the portfolio, I run sort of portfolios, and I've run it in both long only and long short form. And it's a combination of these, looking at uh, individual names alongside what's the actual allocation of the portfolio, um, particularly in an active risk context. Having looked, having run active fund, beg your pardon, index funds, and you sort of see, right, how different's the portfolio from the benchmark that you're trying to track it against. So there's it's an interesting one, because my process, the typical holding period would be around 18 months to 2 years on a name. I genuinely believe that there's decay in the factors and the signal, but the nature of the sorts of things I'm looking at doesn't definitely, you've seen with, you're exactly right. How much is it different market participants driving the price discovery? And SpaceX is an absolute extreme example of that, isn't it? We can discuss that as a separate exercise, because that almost, um, given that it's only just been on the market for not even a week, the interesting challenge is, how do you look at that in the context of what's potentially going to happen with that being included in an index and the price discovery that's going to happen with that once that occurs as well. And interesting enough, that, the biggest challenge I found running index funds was the index rebalancing process. And apologies, jumping around a little bit. The biggest fascinating element of, when I was at Vanguard, we were probably running, I shouldn't say only, but at the time it was about 25-ish billion Australian dollars of index funds. And of course, the brokers are ringing up and sort of say which stocks are going to drop out of the index, Roger, and which ones are going to be added. And because everybody wants to front run the index managers. And it's an interesting challenge, I think, how it's changing price discovery with the amount of money that's in passive strategies. And you've got to take that type of information into account as part of, I think, the process when you construct the portfolios as well.
So what you're doing as an investment officer is that you're aiming. I there was a reason why I used the word aiming, but you're aiming to accumulate data in order to constitute a subsequent
Yep.
market sentiment. And the problem here, or the question that I'm trying to build with you is that, okay, hypothetically speaking, you have or you were able to accumulate
Mm.
any certain data of or any certain understanding from the interaction of the factors. Let's hypothetically say that you know the factors that cause the
Yep.
most of the risk, the most of the variance. I don't know, most of the hedging. You do you now. Based on that, I you were mentioning the word index rebalancing and how
Mm.
challenging it was, and the investment you had passively for 18 months to 2 years. And
Mm.
based on that, you have active strategies and active positions that you will need to find and refine as long as it's trading. And my question or my understanding here, Roger, that would be that okay, so you have like a two-layer approach where you actually consume a sentiment based on your passive strategies. Fix me if I'm wrong, and you refine it with your active positions, so you are able to manage your risk properly. To me, that sounds rebalancing. And I want to tackle the point that you were mentioning that rebalancing is like the hardest thing when you're building an index
Mm.
fund. And how do you actually, create that relationship between passive strategies and passive understanding? Because again, long-term thinking, there is a proper sense in the market, but
Sure.
short-term thinking, not necessarily you have that that
Absolutely.
that understanding of the data. And most importantly, financial factors hold the residual alpha that explains
Yes.
the residual alpha that nobody is able to explain or
Yes.
to interpret from the data. So
I always coin that as
how do you actually magnitude
I almost coined that as
between the two
stock specific
worlds?
risk. No, 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 because apologies, mate, it wasn't perhaps 100% clear. There was a process I had to use when I was running passive. I used to wind up my colleagues that you know, in Australia would always coin index funds passive strategies because you're dealing, an index is a theoretical construct. We've got to deal with real people's money. So there was a whole process that I had to do for running the passive funds, the index funds for Vanguard. The stuff that I've just been describing relates to my own um, multi-factor strategies that I've built since I
Hmm.
left Vanguard. Big difference.
Oh.
But interestingly enough, so I never ran active strategies at Vanguard, only ran index funds. But
Mhm.
what's fascinating about that is how it changed and evolved your view around what factors are important, how you actually go about implementing the portfolio, and as you rightly point out, how the markets change by virtue of the different types of participants in the market at certain points in time. And how do you address the portfolio to um, take that into account? Because I've seen, in like again different contexts, and because SpaceX is going to be added to the MSCI indexes at the end of this week, and it's going to be fascinating to see how people are going to respond. But that's only a small thing because you're still running a portfolio, and SpaceX is a good example in this context because I've just updated my factor model, and you think about SpaceX as a business, it's been around. So a number of the factors that you'd think about are available to use to incorporate in this, what I coined the factor ranking approach, particularly the quality factors, things around balance sheet structure and revenue growth and earnings volatility and those sorts of things. And dare I say, SpaceX doesn't qualify that well on some of them. and
Hmm.
and that's the interesting challenge to take into account around um, uh, whether or not because people ask you, what does your factor ranking model think of SpaceX, Roger, compared to something else? And so that's with my active manager hat on. I know the index guys will be thinking, right, Russell, MSCI, and FTSE have all announced they're including SpaceX in their main indexes at the end of this. Well, beg your pardon, it's a end of June, the last trading day of June, and they've got their own challenges around the fact that, right, they're only including five. They've issued only 5% of the share capital, so that creates its own interesting challenge for them to sort of say the stock's going to be included on the index on the close of this day. So the reason I mention it is it causes challenges with price discovery that are on the active side. You've got to um, who's providing the capital that the index funds are going to show up to buy, and that's a factor that you need to genuinely think about. Is where I'm ultimately trying to get to with all of this, and because I've been on effectively both sides of that equation. Um, it's going to be on, you have to go back, it's been in my brain, mate. You go back and look at BHP's share price on the 28th of January 2022. So BHP for years had two classes of shares, an Aussie domicile one and the London Stock Exchange domicile one. And then they um, decided we don't need two classes of shares, we'll just have one. So the main share class trades on the ASX, and they the stock that trades on the London Stock Exchange is a GDR, but they only count the Australian shares in the Aussie indexes and the global ones. And I kid you not, on that day, 300 million, and this is going to be fascinating to see with SpaceX, but 300 million shares traded on the ASX close for BHP, which, it trades on average. Well, this is the fascinating thing. Prior to that, it was around 4% of the relevant ASX indexes and probably traded around 1 million to 2 million shares a day. 300 million shares traded on the close when it got upweighted. And then
Hmm.
because it's now the biggest stock in the index, it probably is more like 4 to 5 million shares a day's trade from just the nature of how it's and you saw the exact opposite happen on the FTSE index in London when it got dropped from the index. So I'm tipping SpaceX is going to show something like that on steroids. And
Sure.
so then with the process that I've got, I dare I say, most of the time we just avoid it because you know that there's just strange events going on in markets that I don't really want to. There are some market participants, other colleagues who are very good at being able to trade that sort of thing, whereas I tend to take more a longer term view around why am I holding the name in the portfolio. It's not a full on trading process. It's I tend to, like I said, hold names for 18 months to 2 years. Some names I can be quite happy to hold for longer than that. So there's again the real challenge, even in that context, is still having the discipline around a process where you say it's reached a certain point where you go, no, and mine looks at typically are there other names that have got um, you know, uh, more opportunity than the ones that you're currently holding or not.
Hmm. I'm I'm digesting what you were saying because it's interesting the way to approach and the way to diverge like
Yeah.
two stock
Yes.
two stock exchanges and to find similarities between them and to try to aggregate something. And you know what? Let me ask you about your thesis in general, like back then in
Sure.
the days in Vanguard. Um, I want to understand. Okay, if you were aiming to optimize your stock picking process, geopolitically wise, because you were
Mm.
building and rebalancing indexes, um, how do you pick, or how do you refine or define your trading strategies, passive strategies, obviously. Now, obviously, geopolitical events constantly occur,
Yes,
and they change everything. And I would like to understand the underlying
agreed.
risk management thought, not
Sure.
the strategy itself, but as a thought that enabled you to drive such a diverse occasion
It's a
of the
good
index
question,
fund
in
and
fact,
its
because in
rebalancing.
and I'm showing my age around when I was doing the last index rebalancing. I can still remember when Tesla got upgraded from being a small cap stock into the main index in about 2012, I think that was. But the big, it's fascinating how even just taking a reasonably robust and simple process worked quite well. The fascinating one was, to my credit, my boss, the chief investment officer at Vanguard at the time, was the one that really, because he developed some of these processes in the organization he was working at before he helped set up Vanguard. And it was even just as simple as this is different in the context of running an index fund versus how do you respond to that because you're not an index. But so just to give you an understanding from having run a passive fund, right? I kid you not, it was, and it's how it's changed as well. The amount of price discovery that was moving on at the time was an interesting challenge because I kid you not, we just would spread the trading, VWAP on the day, a third on the day, a third on the close, a third the following day. And we could get away with that. This is going back to the late 90s, early 2000s, into about 2005 or six, simply because the amount of money that was indexed wasn't as significant as it is now. Um, and so uh, I kind of coined it with just not being the moron showing up market on cash close because that's what the index is going to do. Because the index will only include, so the typical index rule is right, they include the stock on the close at the closing price. And that's where I gave that example. I always loved using that when BHP got upweighted when they collapsed the two share classes, because that's um, exactly what you tend to see. But it doesn't necessarily always go that way. But on average, it does more than not. And so that was one thing. And then how do you respond to that when you're running a different strategy to an index fund? Because there's just, and particularly now, given, again, it's going to be fascinating to see what's going to happen. I think with SpaceX this week, early next week, compared to when it's finally going to get added into the S&P 500 in 12 months' time. Because I think by the time it gets added, then they'll have more of the share capital will come out of escrow. So the amount that's got to go into the index will be more than what's going in now. So then how do you think about that when I'm running my multi-factor strategy is, right, I'm still thinking around is SpaceX something that I actually want to hold in the portfolio? Does it meet my other criteria? And then how do I go about doing that? And that comes down to um, how much active risk your portfolio has against what you've agreed with your clients. And I've been very fortunate. My clients have given me quite a lot of discretion around. I've got quite large active risk budgets. It's interesting when I first built this process back in 2015, we had some institutional clients and we kind of coined it Alpha Plus because, there's a Butte academic, Jason McQueen. I've known Jason, and he wrote this really great paper and had this phrase that he kind of coined that smart beta makes for dumb portfolios. And so there's a better way you can implement factors than just a pure, very strict factor definition, particularly given the amount of capital that follows different factors now that it influences price discovery. And so you still have to, it's the interesting thing around being running strategies with longer term holding periods, given the nature of the clients that I was running money for weren't short term price makers or traders. It was people typically with ultra high net worths or retirement savings or those sorts of things. So it's a different dynamic that you're thinking about managing the money for. I hope that kind of answers the question. And,
Mhm. Very interesting. Okay, so let's talk about let's change let's have a change in direction, and let's diverge ourselves onto a conversation about risk thesis. and active
Sure.
risk detection, which I think it's very for me it's very plausible by
Mm.
human beings to actively detect the risk. And I think that it's way more than art than it's a practical sense, because people tend to understand the underlying risk as it's forming, where
Made the trade, right?
proprietary algorithms and initial properties are not that able to do the same. And I would like to hear from your very rich experience. How do you tend to navigate the understanding of the underlying risk that affects your current position? What matrices you were looking at? What factors were you're actively looking
Sure.
at? And again, that goes back to the understanding of the practical strategy that you're actively trading, and how to fine tune and make a connection, make a relationship between both. And what I appreciate most of the very 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 high profession people in the field is that they know how to create magnitude in between things. They know how to create linear relationships between non-linear relationship factors,
Yes.
and that's incredibly not professional by me to say, but that's actually what's happening in reality. They know how to think, they know how to create relationships, they have a strength. This is because of
Yes.
that capability. And I would like to hear your
Sure.
capability or your thesis about how to detect an ongoing risk exposure.
What I'd love to do, I'll share it with you after we jump off the conversation. I've written a paper that describes how my factor process works and how you kind of implement these sorts of things, because it comes down to quite a number of different things, most especially the quality of the data that you use, and having definitions of factors that kind of make sense. But there's no point using the same factors that are being used in a lot of these big smart beta index funds, because and it's again an interesting discussion topic around the nature of the information that goes into it. So, for example, um, I try and rely on data feeds that the interesting one is how much you rely on forward-looking data, whereas most of the smart beta indexes typically use historical data to describe whether or not the factor characteristic of stock A, B, and C is preferable to that over stock D, E, and F. And um, it, it sounds simple, but it's actually hard to be able to put together. The one thing I look at, for example, so a common momentum factor definition that the index guys use is, okay, let's look at the 12-month return, the 1 month return, and how different are they? And that's a standard kind of factor that you can't ignore. It's a that does drive a lot of momentum stocks, but um, and there's sort of sentiment factors, but I think you try and evolve some of those sorts of things. One of the sentiment factors I look at, because I keep a track record of, particularly for, it's an interesting challenge because it's different universes of names, but it is a useful tool in the sense that I sort of look at, right, it doesn't matter how many analysts tell you the stock's a buy or a sell. What's the really interesting factor? How many of them change their minds? And it's trying to take that sort of information that's publicly available and take it the next step to be use it in a different way that you know that others are using to try and come up with a better signal for insight. And um, and then putting that information together, then, like I said, I find it fascinating with this factor ranking process because it doesn't, I've seen it in different contexts in other organizations that I've worked with running quant processes that uh, are really, like I said, they're sort of building an alpha directly from the numbers coming from the different factors. And it doesn't take much of a change in the number, and your alpha can just change ridiculously. And where this process works well is that I've seen, if I showed you the time series of the alpha signal that it builds for Microsoft NVIDIA, and it doesn't do this. It sort of shows more, um, you get more insight, I think, from some of these things from that type of approach. So it's I think trying to ensure, like I said, I only trade the portfolio 2 to 3 times a month, and I don't overtrade some of these things. And I think there was something I even just saw a colleague posted last week around uh, these guys that sort of, and to be fair, they were trying to sort of diss active portfolio management, but they said, right, they sort of took some active guys' portfolios and here's the positions they'd published from 12 months ago. What if they did no trading at all on it? How did that portfolio compare to how they actually went? And
Yeah.
they're almost sort of trying to say, guess what? Don't do anything. There's more insight that you had if you didn't do anything than if you did something. And
And again, I think that
yes,
people don't consume the data properly because
agreed.
for me as a
You're
data
right.
science background, I come from a data science scientist background, and people don't misunderstand sometimes that frankly
Yes,
holding is a major decision by itself. This is how
agreed.
the manager
Absolutely.
accepts the market.
Okay.
Oh, my pen fall down. Um, this is how people or the investment committee or the investment officer is
Yes,
actually consuming the market, is actually consuming the data that they're seeing. Now let's talk about data. I think the data, it's a thing that could
yes.
that could
Well, if you're a
leave
data
an
scientist, mate,
investment.
you know exactly where I'm going to come from.
Yeah, absolutely. And I'll tell you what, Roger, I have a great question about the data. I think that one of the major problems that portfolio managers are actively experiencing is not like data, but the abundance of data, and not just the abundance of data,
Agreed.
the
Ability.
vulnerability
Yes.
that the type of the abundance, which is gigantic. Like there are so many
Yes.
tools, so many data reportings, the tools to
Absolutely.
try to approximate
Mate,
or accumulate something
mate.
from
It's
something
almost
and to
appealing
provide
to
an
something.
ROI.
They're going to try and find something that says, "Look, we've found a signal here," and it's like, "Yeah, right." You'd agree with. I always love to remark that correlation doesn't equal causation, and
Yeah,
yeah,
precisely. Like so, understanding the underlying causation of um of a particular subset of data. I think it's rare because finding that underlying that underlying subset of data is a mission by itself. And when you try to
yes,
accelerate or to approximate or to assume more data resources, it's
mm,
getting to be a bigger problem, bigger understanding. I think that
absolutely,
there is not a better way to minimize the data that you're looking at, because abundancy
yes,
creates
yes,
vulnerability, and not the
absolutely,
opposite, or not the other way around. And I want to ask you, how do you know how to filterize yourself as a person? Because you need that type of
yes.
of urgency and scarcity in place,
Sure.
but just to never
I know
extend it.
exactly where you're coming from.
As
Dare I say, mate, you I find the biggest
Yeah,
challenges.
you're
It ends up
smiling,
being
you're
very
smiling
non.
for all of them that actively listening and don't see the video. You're smiling because you know exactly what I'm talking about, or where I'm
Yeah.
coming from, right?
Agreed. Because dare I say, it becomes a very non-quant reason around why you look at some of those things. It's a real interesting challenge around the nature of the data, the quality of the data, and how you kind of put it all together. And it's always been that challenge around, what's a sensible way to use the information to come up with um, a position that you want to hold, and then right, um, you acknowledge that the information's changed, but uh, do you sell the position or not? and um, and then you even the quality of the data is so important. And then the other interesting challenge is client expectations on stuff, particularly. We could almost go down a rabbit hole with ESG data, because ESG is a really important. You cannot knock it in the sense that it's a vital thing that I've seen clients almost demand that you've got a process around how you incorporate in that type of data into your process. But the challenge is it's not, you know, you can, a separate discussion topic whether vendor A, B, and C's ESG data is better or worse. I've found, particularly with local Australian clients, especially clients wanting to run ethical funds and those sorts of things, right? They don't want to hold BHP, Rio, and Fortescue, right? There's nearly 10% of the index just in those three. Oh, beg your pardon, more than that, try 20% of the index just in those. The top five stocks and 10 stocks in the Australian market is 50% of the index. And so they have an ethical reason or an ESG reason why they don't want to hold a name. And you can adapt and evolve processes using some quant techniques for that. But as I've sort of said, you can only use the quantitative approach so far if the client says, I don't want you to hold that name. And
I think
yeah,
the advantage sorry to interrupt you, but the
that's
advantage
okay,
of
mate.
those quantitative techniques that you're mentioning is taking that abundance data and taking that
Yes,
microcosmos of so many data providers and multiples and
agreed.
multiples of the same thing,
Same
but
data. Yes,
those quantitative factors are actually you know giving you an accurate number so you would be able to look at. And
yes,
that number, I think, it's the most enriched data point that you can ever find in order to constitute or in order to preserve your own approach to how do you see the data and
agreed.
how do you see your passive thesis and how you
Yes.
consume it and how you judge it.
Oh, exactly. And I think it's becoming more difficult, if only because you hit the nail on the head, the scope and the quantity of data that's available. And I think you have to acknowledge there's only so much data that any process can consume. And I, be honest, I get a bit skeptical when I see people putting posts up around the, multiple thousands of factors that they look at. And it's like, I don't understand how you can actually distill a process that can give you some reasonable insight. Um, and dare I say, let alone the other big challenge I've found running quant strategies is explaining it to clients why
Mhm,
you're doing what you're doing. And because I've had discussions in different professional and academic forums, you've got to be able to explain that to a non-expert and and make them feel comfortable that they understand what you're doing. It works well, and you're not just overwhelming them with too much technical uh, material. And that's a
mhm,
real interesting challenge in itself. I've found is how to communicate that type of information to clients and prospects. And because it's one thing running the money for yourself if you're lucky enough to do it. I've seen in very different contexts, uh, clients, uh, you think you're trying to explain what you're doing in a reasonably clear context, and you know that you're not. And that's a challenge in itself. And
mhm.
so yeah,
Obviously,
and yeah,
obviously, and I think in a matter of sense, I think it's a bit exhausting to be in a place where you know that you're vulnerable because of abundancy
yes,
and I think that that's constant problem or a constant like pain in the
yes,
field of investment
actually,
committees and investment officers. This should be approached well. And I would
yes,
like to ask you about another thing right now that we haven't really dived into, and I think that that would be the last for today's conversation. By the way, the conversation is great. I love it, and I think that the audience will be able instantly
yes,
to define and to understand the underlying value that it's hidden behind what we're recording here. Um, let's talk about optimization of
sure,
human processes. Now we have spoken about holding period, and the term of hold is a piece of data, and it's a gigantic piece of data that it's very not appreciated. And I really want to ask you, Roger, for a very unique approach. How do you think that you are able, as an investment officer,
mm,
okay, to make more, okay, in the future out of your past data? And how do you think that you're supposed to be optimizing your past data in order to make much more lucrative decisions
sure.
futuristic
Into future,
opportunities?
again a great question, I think, because it boils down to, I think, the nature of I kind of coin it. There is, going people come up with different ways to think about it, but there is alpha decay in these types of processes. And so um, it's interesting. I've used, um, particularly for long short portfolios, the optimizer tends to work better. Um, but it depends literally the number of names that you're holding. The optimizers I've found only work better when you're holding portfolios with quite a large number of names. Like I said, um, uh, the optimization first started with the index funds, 4,500 stocks in the index, and you optimize it to say what's the best 1,000 stocks out of those 4.5 that replicates it. And then in the context, so that's in a passive context, in an index, a peg become an active context. I've been looking at it in the sense of I want to try and maximize my alpha signal subject to a bunch of constraints, and which it typically tends to be things that I've agreed with the client. And um, there's only a finite amount of, I think, capacity I've found with optimizers to be able to do that sort of stuff. It's interesting. Like I said, I've run long short where it's been 100 stocks aside sort of thing, and the optimizer works well on that, through to running long only portfolios for ultra high net worth clients who tell me, oh geez, you got more than 20 stocks in the portfolio, that's diversified. No, it's not. It's people's context on these things, because it's and you want to try and optimize a portfolio that's only holding 20 to 30 stocks, the optimizer will look at you and go, nah. And because it's not designed for that type of portfolio. But then you're absolutely right in the context of where I found the interesting challenge with using the optimizers is, and one of the things I've been looking more at is what's a sensible algorithm to evolve the allocation, because it's a multi-factor approach. How much weight do you apply to the different factors? And it's a combination of what's the investment universe, what's the economic circumstance looking like, and that changes over time. And so the database that I've built, I keep all of the data as at that point in time that I made the decision. You don't go back and refine it, but you look at it again in the context of, right, how did it actually go versus where I thought it should have at the time that I had the information to make the decision. And
Mhm.
I think that becomes an important element of your standard quantitative processes, is just the ongoing means by which that you look at that, and then you can try and get some element of, right, how much of the alpha signal is decaying or not. And it's fascinating because you genuinely see with quality factors, you don't, the alpha doesn't decay the same way it does, more so, say, with momentum factors or value factors. And you've got to address that as you go about um, building the signals. And the signals that I build is this element of factor ranks, and then build an alpha from that. If the mandate says we can hold more names, when I've been only running this thing for typically, you know, it's a 30 to 50 stock portfolio at the moment. My global portfolio holds about just under 50 names. I'm not using an optimizer. I just want it to try and sort of go, right, again, the interesting challenge is, if you look at sort of some academic literature around, is there a preference more towards equal weighted portfolios simply because it's you're not being influenced so much by stock specific risks? Because that's going to be the fascinating thing to see, if and when they include more of SpaceX's capital in the index. How much is that going to change different things? And
Mhm.
how optimizers are going to have to address that sort of stuff over time.
Mhm. Absolutely. Again, back to the discussion about, like, an enhancement or an extended of the
Yes.
active discussion that we're having is is current decision-making processes. Now, once you decide to optimize your factor model, okay,
Yeah.
that's a decision. And
Agreed.
once make a certain interaction with your portfolio, that's a decision. Once you're not making a particular action with your portfolio, that's
Agreed.
another set of
As a
decision
decision.
making processes. And by the end of the day, like, I try to understand how do you accumulate all those all those decision-making processes because they live a fortune of data and active data that you're actively producing without knowing, and the ability to make that data interpretable for you to make much more lucrative
Yes.
decision and to look at what you were deciding in the past and how it actually, had a direct
Yes.
impact over your P&L or over your
Yes. Yes.
afterwards
Return
decision making
your
processes.
alpha.
Yeah,
Yeah.
return precisely. And I think, like, there is a raving race right now to optimize TCA, and there is a
Oh,
raving
you're
uh,
so right there. Agreed.
that's there is a war that, like, an underlying war that we don't see visually, that
Agreed.
actively they're actively happening right now. The time that we're speaking right now, I know of 3 or 4 academic researchers globally
Mm.
that try to optimize and to rave for TCA. TCA is transaction cost analysis. So
Yes.
meanwhile, they're trying to optimize their transaction costs to
Yes.
make more residual alpha. But I think that where residual alpha actually lies is in between the human decisions. Because as I told you, and we have already
Mate, that
agreed
is, I
that,
could not agree more. Could not agree more.
yeah, I just want to ask you, okay, people live data within their decision making processes. No one is actually optimizing it, and no one actually enables them to make ROI based on their past data, to make more of an opportunistic approaches in the future. And I would like to ask you, Roger, out of your perspective or point of view, what type of data do you produce? Okay. So, and what type of matrices you like to of metrics you like
Mm.
to look at, um, in order to understand how the past data that you have generated and you have accumulated
Yes.
over time enables you to increase ROI, increase
Yeah,
margins,
more reliable. Yes.
lower losses, so on and so forth.
Yes.
Stage
No,
is yours.
that's so there's literally the process that I work through. So like I said, I only update my factor analysis 2 or 3 times a month. And then what I'm looking at is just right, I've got an alpha signal now from the process that I've built. How did it perform? And how did it perform not just over the next week? How did it perform over the next month, next 6 months, next 12 months? So I have a much longer holding period that I'm happy. And the real challenge, of course, is
And it's still a
convincing
decision.
clients to do that. Yeah.
And it's still a decision.
And
Every time you
you
optimize your
make,
factor
I
model,
say,
it's
hi,
still a
mate.
decision.
Agreed. Because you just don't know how much of the information that's in that alpha signal you've generated is something that's going to decay really quick or something that's going to decay over a much longer time frame. And it's interesting, I've been doing a couple of different things over and above running my own strategies. And it's fascinating. I've seen how um, the nature of the alpha decay changing when you don't look at it as regularly as you normally do. And the portfolios have been performing well still. And so there's a really interesting challenge around um, not overreacting to information. And yeah, it's a real um, particularly given the nature of how to my mind, it almost relates also to how the factors have evolved, and then how relevant is that to the particularly when you're looking at the different businesses that the stock represents, and um, everything from uh, utilizing different signals to be able to go into the calculation of the alpha signal, and then what needs to change as time evolves as well, because in different economic environments, the factors mean different things. And so you've got to be reasonably robust with how you test it and then go, right, what's that signal provided for me? Okay, that's something I can use in a different uh, sort of market context as well.
Mhm.
Um, everything from uh, my sister runs fashion retail. She designs and sells ladies' shoes, and it's
Hmm.
interesting how her business is growing. You'll appreciate this as a data scientist, mate. Is that for quite a few years, Karen would reach out to me saying, "Oh, Rog, can you help me do the data analysis?" Her husband's the IT guru that built her website, and that's fine. I'd quite happily help do. She's built this amazing business selling shoes online, very fashionable ladies' flat soled shoes. That's my very, I always remark, mate, you've got to have a very different set of factors to what the index guys use. And how well is my sister's business going? That's my key signal indicator on consumer sentiment. Is her how I've been helping her do the analysis of her online sales. And yep, she doesn't need me anymore. Her business has grown quite well. She's got some specialists who help do that for her. And oh, the bloody lights have gone out in here. And so, beg your pardon. And but where I'm coming to from that is that's a fascinating alpha signal in itself when you look at the nature of the information because she wants to look at information over a more reasonable time frame as she's looking at her sales. But that's a useful alpha signal for me because there's a consumer sentiment indicator around, is her very consumer discretionary business performing well or not? And got to have something different. And that's how I think about it.
Absolutely. Absolutely.
Yeah.
Okay, Roger, I have nothing to say, but thank you. Thank you for coming. I think
Yes.
that the conversation was incredibly helpful for people to think or to understand how does people that run portfolios and run investments
Yes.
for a very, very long time actually thinking
Yes.
what are their actually pain points. So I really
Yes.
want to thank you for the entire discussion. It
I
was
really enjoyed it,
incredible.
effort.
And
Much
I know
appreciated, mate.
the pleasure is mine.
Yes.
And yeah, thank you everyone for listening. Roger, again, many thank you for coming here. And see you soon in the next episode of the Blushing Quants. Bye everyone.